SYM keeps a high bar for any category of investment that we would consider for client portfolios. It needs to have a theoretically strong internal rate of return. Bonds have literal, written, enforceable promises to pay on certain dates and certain amounts. That's a valid investment. Stocks, it's not quite that tidy, but you own diversified businesses and you're entitled to the profits and dividends that they pay out over time. What's the beauty of that? Well, as their prices fluctuate, we know that we're owning this stream of payments in both categories. And we can be more confident that it ends well with time. We don't need to say we bought it for 100, it goes down to 80. Uh-oh, should we sell it? Should we buy high and sell low because maybe it's gonna go to 0? We can be more confident that we can stay the course with a good strategy because of that internal rate of return. Gold does not have that. Gold doesn't pay legally enforceable promises to pay you cash on certain dates. They don't have profit streams that's growing. Gold does not have a profit stream that grows that pays out to the investors. It's just a metal. It's an element that sits there. Some people even have to pay to guard it or to store it in a safe or something like that. So buying gold is only a bet that somebody else will be willing to pay more for the gold later. And how on earth could you forecast that? I can't forecast that. I don't know what people will want to do. And in that moment, they're not willing to pay more than what you're going to pay, or else the seller would sell it to them. So a lot of times you hear commercials advertising gold and telling you how it's just going to be the best thing ever. But remember, these people are paying money trying to trade your dollar bills for their gold. Are they really acting as your advisor by paying money for the advertisement to try to sell you gold? I tend to think probably not. And going back all the way to the power of a theoretically strong investment like stocks or bonds, if gold goes from 100 to 80, is there anything that says it couldn't be a multi-decade decline? Maybe somebody will only want to pay 50 for it in a while. And we've seen multi-decade declines in gold. So I just want to save clients that pain, and we only stick with investments that have that internal rate of return, which gold does not satisfy.